Hey, what's up everybody? Welcome back in. My name is Jake Hoskins. I'm going to be your professor today, apparently. So hopefully I can give you some good advice and something interesting that you can take with you in your life, and maybe it can help you a little bit down the road. So today's episode is going to be called Market Mistakes. And when I say market mistakes, I mean things that potentially could go wrong in your buying and selling of individual stocks, if you choose to do that. So these are mistakes that I personally have made, and they're kind of the most common mistakes that I see other people making as well. So I'm not giving you some magic formula as to how to make money in the stock market or anything like that. But I am going to give you some things to look out for. So if you want to go invest in individual stocks, you can be a little more well equipped to do that after this video. So before we really launch off into this video, I'm going to start off with some sayings from Warren Buffett and kind of give you his thoughts on investing. So Warren Buffett, first of all, is considered by many to be the greatest investor of all time. And so his thoughts on investing are, you're buying a business, not necessarily buying a stock. So think of it as you're buying a business and you want to hold it for a long time. So he says, pretend that if you bought a stock today and the stock market closed for 10 years, would you be okay with that? Would you be okay holding that business 10 years down the road if you never had the opportunity to trade it again until that point? So I think that's a really good way to think about investing. Kind of gives you a little better perspective as to long-term investing. So Warren Buffett gives an example of your house as an asset that you would buy like an investment. And so, you buy your house at a certain price, and imagine if somebody came up to you every day and gave you a price that they would buy your house for. And they did this every single day, Monday through Friday, forever. So every day they quote you a price that's a little bit higher than yesterday. Maybe they give you a price that's a little bit lower, and so on forever. Would you just suddenly sell your house because somebody came and offered you, 3% more than it was yesterday? Probably not. You bought your house for a reason. You spent a lot of money on it. You're going to keep it at least for a little while unless something drastically changes. And so that's sort of Warren Buffett's philosophy on this, and I've sort of adopted that myself. And so if you want to sort of learn more about that type of investing, you can go read a book called The Intelligent Investor. Warren Buffett didn't write it. It's a guy named Benjamin Graham. But he was Warren Buffett's teacher, so maybe even better. So go read that book if you want to learn a little bit more about that style. So let's get started with this video. And the number one mistake I see people make in the stock market is shorting. So when I say shorting, I mean short selling a stock. And when you short sell a stock, it means that you, get ready for this, you sell a stock that you don't currently own. So that's kind of a weird concept to a lot of people, and I get why. But so basically what happens is you borrow a share of stock that you sell it into the open marketplace. And let's say you short a stock at $50. That means you borrowed the share of stock from your broker usually, and you sold it onto the market for $50, and so now you have $50 cash. That sounds great and everything, but at some point you have to buy the stock back. And so the reason that you would short sell a stock is if you think the stock is going to go down over time. So think about it this way. You short sell a stock at 50, so you sell it out into the open market, you get $50 cash, and let's say the stock price goes down to $25. You can go buy that stock back for $25 and you can keep the $25 profit. So that's how that works in theory, but in actuality it never works. So I'm going to give you some mistakes as to how shorting could go wrong, and there's a lot of ways. So let's look at a XY's type stock chart here, and let's say you buy a stock at 50, or you short sell it at 50, and you're hoping it goes down here somewhere, okay? So it's going something like that. And so on a short sell, the most you could make is $50 on this particular stock, or 100%. So your gains are capped at 100% because the stock can only go to zero. It can't go lower than that. And so you're betting that, the stock goes lower. So capped profit potential on this, that's sort of the first thing. But then the main problem with this is that, let's say you short sell it at 50 and this happens. So if that happens, you're kind of screwed, because let's say this stock goes up to $500. You've just lost 10 times the cash that you originally received, which was $50. So you received $50 that you invested, and you lost $500. So this is the extreme danger with short selling, is that you can lose money that you don't have. And this is how people have huge losses and go into debt and everything like that. Just with investing, they short sell, it goes tremendously and fantastically wrong, and they're out 8 or 10 times the money that they just put in. So you lose money, infinite losses theoretically, but only capped profit potential. So you can see why short selling is a horrible idea. And by the way, I said, when you short sell, you borrow a share of stock from your broker. That broker's going to charge you about 8 to 10% interest as long as that short position is out to borrow the stock. And the stock market goes up on average like 8% every year. So you're betting on against the averages, and you're taking an enormous risk here. So short selling, absolutely a horrible idea. So the number 2 mistake that you shouldn't make in stock market investing is similar to short selling. It's called leverage. And so when I say leverage, I'm talking about borrowing money to invest with. And you can see how this would be a horrible idea as well. Because let's say you go out and you borrow $5,000. Well, that sounds great and everything, but that $5,000 isn't yours, and you're going to have to repay it eventually, regardless if you make money in the stock market or not. So again, that could go horribly wrong, where you go borrow $5,000 from the bank, you invest it in the stock market, and the stock market crashes, and you have $2,500, and then it comes time to pay back the loan, and you have half the money that the bank gave you. So this presents a serious problem where you lose money again that you don't have, and you can really dig yourself into a hole with these two, like I said, because not only are you losing your own money, you're losing somebody else's money as well, and that's money that you don't own. And so you can get into big trouble really fast. And these sort of rely on predicting the future. And if we could perfectly predict the future, of course we could do these perfectly, but unfortunately that's not the case. So yeah, don't borrow money, don't leverage up, as they say, to invest in the stock market. So the third mistake I see a lot of people make, and I've made as well, is waiting. So when I say waiting, I'm talking about like big picture. So, waiting, let's say, into your 30s to start investing. And, I see a lot of people that have money in their 20s or even in their teens that they could be investing with. Now, I'm not saying you have to invest every single dollar that you have, but it's a good idea to start early so you can start that compounding process of, on average it's like 8%. You can compound your money at 8% per year. And so every year you can do that, you're getting a huge advantage in your financial life just from, starting your investing early. So, I see this with a lot of people because they'll have some money when they're 18 or 20 and they want to do something with it. They're thinking about investing, but they're like, I could just buy a new car and then all the girls would love me, and why would I need to invest in the stock market? Sounds like a good plan, but rarely works out. So the wise thing to do, probably go ahead and get started with investing, and you can put that time value of money on your side, and that'll really help you out down the road. So the fourth mistake that I see people make is what I call market timing. And so market timing, so when I say timing, I'm talking about having this idea of trying to perfectly time the high and low points of the market so you can really build up your money really quick. In theory, that sounds like a great idea, and if you could perfectly do it, you could just make basically an infinite amount of money. But let me show you sort of what I'm talking about here. So when you're trying to do market timing, you're trying to do basically where you have your stock price here, and so it's fluctuating over time. Maybe it looks something like this. I don't know why time went backwards right there, but anyway, so you may have the idea of I could probably make a lot of money doing this if I sell it all right here, and then I wait a little bit and I buy it all back right here, and then I wait a little bit longer and I sell it all back right there, and then I buy it all back right here, and then I ride the roller coaster all the way up and I sell it all off right there, buy it all back right here, and you get the picture. Sell it all back right there, buy it all back right there, and so forth. So in your mind, you're thinking, I can get all the positives and none of the negatives here. Or people think I'll just buy it right here, short it right here, buy it right here, short it right here. So you would just be climbing higher and higher and higher forever. And if you could predict the future, that would be nice. But in actuality, you may think you're here, you sell everything off, and then the market just keeps going up for 3 more years. So that's sort of the problem with this. If you could actually do this, you would profit on this chunk, 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 all stacked on top of each other, and you would basically have infinite money. But simply not the case. So don't try to do market timing. because I'm sure you're very smart and you're a stock market genius and you have your own trading algorithm to do all this, to figure it out perfectly. But that's on your own time. Don't try to do that. So the fifth and final mistake that I'm going to talk about here is what I call chasing. So chasing is sort of a word I made up. You probably won't hear many other people say that when they're talking about the stock market. But basically, when I say chasing, I'm talking about wanting to make up for mistakes that you might have made in the past, or you want to make up for some indecision that cost you some money, previously. So I'll give you an example here. So let's say that you're thinking about buying Tesla stock. And, you're sort of on the fence about it. The stock price is sort of bopping around right here a little bit, and you can't really make up your mind whether you want to buy it or not. And then the stock price starts doing this, and you feel a little left out, and you're like, oh man, what have I done? I've let it go all the way up to here when I could have bought it right here. And so you chase and you do something like this where you're like, well, I better buy it right here before it goes up any higher. That way I won't have this mistake looming over my head. I'll own Tesla and I can be in for the rest of the ride. Odds are when you do this and you buy right here, you've probably just successfully bought at the highest price, or at least it's going to be a really inflated price. And so, when this just climbs up and up and up, the emotions in your head are building up. You say, I've got to get this. You buy right here. There's a good probability that it's not going to stay there forever and you're going to lose. So if you miss out on something and, just sit down and realistically think, what's kind of the fair value of this stock, and sort of stay level-headed. Don't try to make up for your past mistakes. Just move on, find another opportunity, and you'll be a lot better off that way. So the commonality with all of these things is people are trying to make quick money, and quick money can get you in trouble really quick. There's no such thing as quick money. If you make it quick, you can lose it quick. So just remember that. So again, I'm going to remind you of the Warren Buffett advice of remember that you're buying a business, and just because you can sell it every day doesn't mean you should sell it or buy it every day. Another thing Warren Buffett says is, in the stock market, it's like you're standing at home plate and the pitcher is throwing you pitches. You don't have to swing at any of them if you don't want to, because in the stock market, there's no called strikes. You can stand there and look at as many pitches as you want to, and eventually, if you see one that you really like, you can swing and hit it out of the park. So that's the thing. You don't have to be buying and selling all the time if you don't want to, and I would recommend not. So anyway, thanks for watching this video. I hope you got something really valuable out of it. Like I said, I've made all these mistakes right here. Well, I've never actually done leverage. I've never borrowed money to invest with, surprisingly. But if you got something out of this, leave a comment in the section below. I'd like to hear if you guys have made any of these mistakes. And so click the thumbs up button too, and the subscribe button. That really helps me out a lot as well. So till next time, thanks for watching.